Okay, thanks, Mark. We'll get going. I hate to use the lamest sales, motto in the world of I'm standing between you and the cocktail, but I am. So we'll try to cycle through this quickly. It's been a great relationship with LaSalle. I met Mark a year and a half ago or so here in Oak Brook. We hit it off at lunch. He said we have no mutual fund sponsors on the platform. He also wanted to play golf with me, so that helped, I think. But I took the idea to my home office and said, there's a great firm in Chicago where I live that I want to partner with. And it's been a great relationship so far. Just since the Top Producer Conference last year in New Orleans, which many of you were there, we've raised a lot of money at LaSalle and also raised a lot of money around the country. And I don't think it was a coincidence on timing. Raise your hand if you've been unhappy or surprised with any of the conservative holdings or mutual funds within your client allocations. I think that conference was around September 19th or so. The market peaked May 21st. We sort of declined a little bit. Stocks rallied again up to November 3rd or 4th. And so right after that guy from Sierra talked at the conference and you guys started to get to know me, market went straight up. Why do I need a boring conservative story when the market's rocking and rolling? As the sheets are passing around, there's a Morningstar report of performance since that market peak May 21st or so to a couple Fridays ago. There's been a really big move down with some of the best, some active, more passive, conservative managers who have experienced some downside. And it's been the first time in a few years, right, since clients have felt volatility. I could have paired up with Sortino advisors in terms of philosophy. We cater to the conservative client, the retiree, the person that doesn't really care about modern portfolio theory and taking on a lot of risk. We cater to the client that says, I don't care what the game plan that you sold me, I'm down 10%. I open a statement that's down 10%. I have a kid's college bill coming up the next month or a medical bill that's, $11,000. That 10% is a $10,000 decline. And they say, oh my gosh, I can't stomach that volatility. I need something different. So finally we get some volatility and financial advisors are saying, hey, it might be a good time to not try to find the next best opportunity to crank out 15%, but manage risk in a tough environment. So I'm here to refresh. I've met a lot of you, so thank you for the opportunity to allow me to come into your office and try to partner up. Some good relationships built so far, and I'm excited about moving forward with this partnership at LaSalle. So I'm going to refresh you all on a little bit on our perspectives. I'm excited because a lot of it ties into the Sortino philosophy of postmodern portfolio theory. So there's a lot of good takeaways and similarities there. We're going to talk about loss aversion. I finally found anytime golf and work come together, not just on the golf course, I get excited. I found a really cool study that two Wharton professors did on the PGA Tour and tied it to behavioral finance and this concept of loss aversion and human bias towards losing, towards a benchmark. And then we'll talk about cycles a little bit, where we are, what our companies thinks. We'll go through our process. Our investment process is the most important thing that distinguishes us from the rest of the competition. So we'll cycle through that. And then we'll go through our two strategies to show you what they do, how they might fit with your client allocation. So avoiding the agony of a bogey. Who here plays golf? A couple. Who can name the #1 golf program, college program in the country?
University of Illinois.
All right, my alma mater. I played on the golf team for 1 year in 2006 at Illinois. That was the exact year that they went from mediocre to really good, and I think that's why I only lasted 1 year, because I was the last end of the mediocre golf until they have now rose to #1 in the country. Pretty cool. So these two Wharton professors did a study, and they took a lot of data and analytics on the PGA Tour, and they targeted a lot putting. And they did I found a pretty interesting statistical significance or occurrence that golfers on similar distance of putts, there was a difference of results on putts that were for birdie and putts that were for bogey. They found that the birdie putts were more often left short than the par putts. And that wasn't because it was a coincidence or any other outside factors. There's a human sort of bias of loss aversion to a perceived benchmark. In golf, right, it's par. You don't want to drop a shot. You don't want to make a bogey. So golfers are a little bit more apprehensive on their birdie putts not to blow it by 5 feet to have a tough par putt coming back. And the par putts were left, the ones that missed much farther. So according to their research, for many, the agony of a bogey seems to outweigh the thrill of a birdie. And people work especially hard in order to avoid loss. And does that resonate to some of your clients in that Sortino Advisors philosophy? That it's not that if the market's down 35 and we're down 28, we should be popping champagne back in our home office in Santa Monica, because your client is not happy with down 28. It's a perceived win or loss to a benchmark, and it all ties back to the client's goals, their needs. Are they saving retirement, college, payments, so on and so forth. So at Sierra, they've developed a unique process to cater to this demographic of conservative clients, retirees, keeping losses really small and cranking out conservative returns in a tough environment. And they actually studied Tiger Woods, and he had an interesting quote that said, anytime you make big par putts, I think it's more important to make those than birdie putts. You don't ever want to drop a shot. So pretty interesting. I can send you the study if you're interested. So some of you saw some of these slides in New Orleans, a couple tweaks on them, but the cycles in the economy, the cycles in asset classes, behavioral finance cycles is very important. It'll get you thinking sort of how we think as money managers. Who's familiar with secular bull and bear markets? A couple hands. The green swath, this is the Dow Jones going back almost 120 years. The green swaths are secular bulls, point A to point B straight up. The red swaths, secular bear markets, were prolonged periods of time, a lot of volatility, not a lot of productivity. From 82 to 2000 is when Wall Street, mutual fund complexes, the industry was pushing buy and hold and modern portfolio theory and Monte Carlo analysis and all this sort of stuff that worked really well in 1,000% straight up move in the Dow. And now we're getting to the secular bear market area where things are a little different, right? We're seeing dramatic swings. Clients are experiencing something that they haven't in times past. So how many of you have clients that are 40, 50, 60, 70 years old? Perhaps a lot of their peak earning investing years were from 82 to 2000. They were trained in this modern portfolio sort of environment where if we just ride out volatility, give it enough time, we're going to make a decent return. Don't try to time things. You can't time the market, so on and so forth. That could be true. I'm 32 years old. I bet you if you put me in the S&P 500, turn the clock back 30 years, I'm sure there's going to be some gains. But for a retiree, a conservative client, or just the safe part of an allocation, what is the time horizon then? 6 months, a year, 2 years? They put much more emphasis on keeping losses small and capital preservation than a good return over a long period of time. So this is sort of the broken bicycle environment that we're going through. In the tech rec, we were up 106, we were down 50, up 101, down 60, and as of the end of last year, we were up 202%. We've given back some of that, but still hovering that environment. And have your clients start to reevaluate their thoughts on risk. My sales ideas lately, when working with financial advisors, we can do wine tasting and golf events. I'm doing a Top Golf event, by the way, April 6th. Some of you might have got the invitation with their co-founder, as well as some lunches, so hopefully you can make it there. But my sales idea now is to take this recent volatility, take some of the downside moves that perhaps they've seen in their accounts, and talk to them about risk. Talk to them about their goals. Are you comfortable with a 10% decline? Or there might be a more appropriate strategy to keep losses small in a tough environment and take a lot of the investment management burden off your shoulders in a low interest rate environment to drive returns and keep losses small. Cycles in interest rates. Who wants to predict where the 10 years go in the next year? I have no idea. It's been a 30-year decline in rates, very bullish for bonds. How many portfolio managers shortened duration 2.5 years ago to get ahead of rising rates? It was the complete opposite trade, right? At Sierra, we have a process that can navigate through any environment, rising rate, falling rate, inflation, deflation. Our co-founder keeps saying, if there was anyone in the history of the world that could accurately predict changes of trend in interest rates, we would all in this room know his or her name. No one can do it. You have to have a process. The last speaker with Fidelity, very interesting process you can go through that might help your business. This is not just adding a strategy with a brilliant bond picker or some really smart guy in Santa Monica. This is adding a really unique investment process that is catered specifically towards the goals of conservative clients and retirees. This is the crux of what at Sortino believes in and we at Sierra have believed in for over almost 30 years. Behavioral finance, the market emotional roller coaster. Where do we think we are? In optimism, excitement, thrill, euphoria? Or are we in the anxiety, denial, still talking heads to this day say we've given some back, but there's still a lot of good data out there. Don't worry, we'll trade up for the next year. Who knows what's going to happen? But you've got to make sure you're protecting your clients from this and their portfolios, particularly that conservative demographic, because the equation has changed dramatically for you as financial advisors. Life expectancy in 1955 was 69, retirement age 68. Raise your hand if you can come up with a one-year income portfolio. I could probably handle that task. In 2005, and what's the statistic in 2016? What's it going to be in 2026 with technology exponentially growing? I used to say as a kid to my parents, there's going to be a pill for everything. Don't worry, there'll be a pill for it later. Technology is growing, right? And now this is affecting you as financial advisors with 16, 20 plus years of retirement. What do? Do you buy a high-grade corporate buy and hold bond fund? What if rates rise? Do you take on equity risk? What's the most damaging outcome of a zero interest rate policy by the Federal Reserve for many, many years? It's forced savers, retirees, folks who would love to go to Chase and budget out their income at 4% CD, but they can't do it, right? You're going to have some good solutions with Sortino. We work great on the fee-based side as well, and ANC shares to provide that need to keep conservative clients out of trouble and earning a reasonable return. So I was tasked with tying in Wayne Gretzky, which I also love this quote. He said, "A good hockey player plays where the puck is. A great hockey player plays where the puck is going to be." And so my little take on that is this chart, which is sort of the crux of our firm at Sierra. Playing to where the puck is trying to beat a benchmark year after year. How are we going to beat the benchmark? Or are you going to try to go to where the puck is going to be, which is the goals of retirees and conservative clients? So for that part of the portfolio, we want to make sure we're keeping losses small because the math is not in our favor. If you lose 5, you make 5.3 to get back to even. If you lose 50, you make 100 to get back to even. So it's really difficult, and we've gone through it now. There's a lot of conservative funds managers that can't get out of high yield, or they have a million excuses as to why their fund is down, and they may be very valid. And that's not to say they stink and buy us. It's to say, for this demographic who wants to keep losses small, there's got to be a different way. Fortunately, at Sierra, they've developed a process that's worked and avoided every big decline in the past 30 years. The tech wreck, 2008, the debt ceiling debacle in 2011, the taper tantrum in 2013, the volatility this year. I'm working with a lot of advisors. They're doing business now. Some are saying, I'm just going to wait and see and see what happens. I'm not a pushy wholesaler, but I do think now is a great time to be talking to your clients about risk and making sure the next 2 years, if you don't believe that the next 2 years are going to be just like the last one, it could be a perfect time to help manage risk for this conservative demographic. And the Oracle of Omaha, Warren Buffett, said it best, as sometimes he always does. when describing the collapse of long-term capital management, he described the collapse as to make money they didn't need, they risked what they did have and did need. So to make money they didn't need, they risked what they did have and did need. And how many of you have clients that would resonate with? Should the conversation being how are we going to get the next 15% return, or what are we going to do to protect a nest egg that they've worked so hard to build to keep losses really small? So that's a little bit of our thoughts and perspectives on the market, on how we think about investing. So a little bit about Sierra, if you don't already know, we were founded in 1988 as an RIA. So we've been on your side of the table. We still are on your side of the table. Firm-wide, we manage almost $2 billion. And everything we do is managed with two absolute return goals, which is, so going to where the puck is absolute return goals, which keeps conservative clients happy. A reasonable return, and please don't lose my cash. We have one process, two different flavors, and two different mutual funds that try to accomplish that goal. Here are the two co-founders. David Wright is who's going to be in town April 6th and 7th. A lunch in Oak Brook on the 6th, a lunch in Schaumburg on the 7th, and Topgolf at night on the 6th. Hopefully many of you can come and attend that if you're in the area to meet the co-founder who developed, in part, a really unique investment process that we're going to run through. So who's heard of trend followers? Anyone trend following? Technical analysis, a couple? So at heart, we are trend followers. And we sort of have three parts to our unique process of conservative returns, and please don't lose my cash. And it starts with broad diversification. So to oversimplify in a dummy sales way, we use a combination of a middle moving average and a high and low trading band. And the bands are wider or narrower depending on the asset class. And that particular asset class is historic volatility. So they took as much data as they could find in the 80s to do a deep dive and study into volatility and volatility in each asset class. So we have buys and sell signals using these trend following techniques to allocate into an asset allocation regardless of the environment. Inflation, deflation, rising rate, falling rate, risk on, risk off. There's going to be a group of asset classes that will prove productive in a given environment. That's why you'll get a wholesaler call. You probably have 15 in your voicemail already today that they say, hey, this is Jeff from Sierra. I've got this really great high yield fund. You've got to take a look at it, or whatever asset class. It just hit 5 stars. Please call me back. It's probably because that fund's asset class has been in an uptrend for 18 months, and they got a great manager, so kudos to them, and you want to take a look at it. So we try to find as many of those good ideas to put them into one robust strategy that meets the needs of conservative clients and retirees. So if you look at your fact sheet, sort of step one of, you mind if I borrow yours? Thanks. Step one of risk mitigation, you'll see a whole bunch of asset classes. We highly diversify by asset class in whatever there's opportunity in the market. So that's step one. Step two is a strategic allocation. If you move your eyes down from that allocation, you'll see our top holdings. Who can guess what looks different, unusual in our top holdings for a sleeve of golf balls? Cash is a good answer. Jim gets the golf balls. Any of them. What you don't see is Google or Apple or GE bond, no individual securities, right? You see mutual funds. So our vehicle of choice to trend follow each of these asset classes is mutual funds and occasionally ETFs. So we are a fund of other funds. And that's by design. It's an extremely efficient way to participate in all these asset classes, particularly because of our sell discipline, which is step number 3. Who's heard of trailing stop losses, or stop losses in general? A few. Under each holding is a customized trailing stop loss that brings that position to cash when something unusual is happening in that asset class. So this is an oversimplified version of a moving average where it crosses through the moving average. You sell, you buy back. You can avoid a big decline by very unemotionally and quantitatively going to cash when something unusual is happening. So our fund can go up to 100% cash very efficiently. If we were using individual securities, we'd have to call Morgan Stanley's trading desk and say, hey, this is Jeff from Sierra's trading desk. Please sell $750 million of individual issuances. They'll laugh at you on the trading desk and say, these bonds have no bid. I'm sorry, you're stuck unless you want to take a 50% haircut. We type in a ticker symbol and go to cash. We're the only fund in the room that can go to 100% cash by 3 o'clock today if we really needed to. And that's huge for managing risk. Here's another graphical representation of stop losses. This is going through the tech rec and high yield. The bottom is buy and hold. The top is applying our stop loss discipline. And you can crank out over a 30% return with no correlation and low volatility. And when you do that with all the different asset classes and funds, that's how we become experts through a process of singles and doubles, capital preservation, low volatility, keep clients out of trouble. So how does this process work? To kind of sum up how it moves around very unemotionally, and I'll take you again, if you've seen this already, a refresher on through 2008. Obviously an important time to show a manager's stripes through a really tough episode of volatility. So March 31st of 2008, this has temporary haven, some equities, some bond funds, some low duration bond funds. 38% temporary haven is cash. We purposely call it a temporary haven because it's noting that it's not our PM saying, I'm nervous about something in the future. Let's sell now and manage risk, or let's shorten duration now to get ahead of future perceived risk. We end up temporarily in a haven via the stop losses. Unemotional, quantitative. June 30th, we're in 54% cash. September 30th, stop after stop after stop. We're in 80% cash. By the way, high-grade corporate bonds and treasuries at 23% stay within the portfolio, not because our PM said, trust me, guys and gals, I know the VIX is at 80 and the world's falling apart, and Lehman went bankrupt and Bear Stearns went bankrupt. Just trust me on this. Flight to quality, treasuries will rally, high-grade corporates will rally. Believe me on this one, I got a gut feeling. There's none of that going on. 23% stays within the portfolio because they simply just don't hit a stop loss. So it takes the guesswork out of when to sell. Trend following back in, the opposite of the sells are buys. 47% bonds, some equities, some low volatility, 50% cash back to work. March 31st of 2009, 2 weeks off the bottom, right when behavioral finance, right when your client calls you and says, oh my gosh, I can't take it anymore. I just got off the golf course. The market's down 800 points. You told me to hang on. You told me to hang on. I believe you. I trust you, but I can't take it anymore. Please sell, right? Cycles throughout history. What happened to the Sierra fund? We were in cash 4 months ago, and now we have 3% cash and fully invested. This is how we were down 2.8 in 08 and up 30 in 09, not because we're the oracles of Santa Monica, but because of this unique process that grinds itself through 2008, through the tech wreck, through this year, through, you notice the 43% cash on the fact sheet is because we hit stops, went to cash. That's how our funds are positive year to date. So a track record, a process that works. This is our SMA that started in 1995. We go quarter by quarter, hard to see here. We actually highlight the down quarters in red. I would love to see how the Sortino firm how they would crank out through their models. On a monthly, quarterly basis, we do a particularly good and unique job at managing risk, keeping losses small, delivering consistent, stable returns for conservative clients because of this process. It's great to see the industry shifting after 2008 and every big mutual fund company is coming out with long, short, and unconstrained, absolute return, strategic income, so on and so forth. We've been doing it for 30 years. It's worked extremely well. And I was one of 3 wholesalers I've been with the firm for almost 5 years. And just in the past 6 months, we've added our 6th wholesaler. We're going to go to 10. We have a national sales director, key accounts. This is sort of our coming out party, and we're gaining a ton of traction around the U.S. Because we think it's a great time for advisors to get their hands on something like this, to take the burden off your shoulders, to keep clients out of trouble, because the mutual fund complex just isn't set up to do that quite efficiently for this demographic who wants to keep losses small and hit singles and doubles. So you get sort of, I hope, the process. I know that's a lot at one time. We'll go through really quickly the 2 mutual funds, how you have exposure to this process. The Core Retirement Fund came out at the end of 2007, so 8 years ago. When you're screening for conservative funds, risk matters, details matter. We lay it out to show you the devil's often in the details. Best year at 30, worst year down 2, best quarter up 20, worst quarter down 3.5, best month up 11, worst month down 2.4. When you're screening for funds, don't just use 1, 3, 5, 10 and standard deviation. Hopefully some of you will use Sortino's new process, which it sounds like we love. Our philosophies are very similar. You've got to look at max drawdown, and not just standard deviation and Sharpe, but downside deviation. We include the Sortino ratio. It does help at showing a manager's difference at managing downside risk. Standard deviation is just up and down volatility, right? How many of you, do you get client complaints about any up volatility? I'll take any up volatility. It's usually the down that matters. And a couple of the Zephyrs that I printed out sort of highlight some of this compare. I promise I'm not violating Wholesale Rule 101 and negative selling against my competition. These are the best of the best flexible managers. We're on the core fund, so we'll turn to the second page. Some of the best flexible active managers out there. It's not to say we're necessarily better and they're worse. It's to show a true difference in value of what you're getting and experience for a conservative client. We've kept up nicely with performance, mainly by keeping losses really small. But when you look at us with the standard deviation under 6, compared to some other really good managers with standard deviations of 9, 10, 11, 12, 13, that's a big difference. That's half the volatility. And as Sortino agrees, it's not just standard deviation that matters. Look at max drawdown. Our max drawdown was 6.23%, huge difference than down 25, 30, 35. So you can get to kind of similar places, go to where the puck is, the goals of a conservative client or retiree. You can get there 2 different ways. Higher standard deviation, hold on for 7 or 8 years, and we'll get you there. Or perhaps the client says, you know what, I'm 65 or 70 or 75, perhaps getting towards their retirement age or demographic. They just don't want to open statements that have big losses, and this is where we can come in to complement allocations for the safe money. So here's the asset allocation as of the end of last year, 28.6% cash. This has all been, we've hit buy signals. This has all been reallocated as of a couple days ago. One of the ways we can take on, say, high yield NAV risk, right? How many managers overweighted in high yield in a low interest rate environment? The oil market collapses. They're stuck in high yield. They can't sell it. Bonds with no bid. We got stopped out of high yield last fall. Our stop loss was 2.5% in high yield. We hit buy signals a week and a half ago. It's been a good trade so far. So you can take on NAV risk. What risk do you take on for searching for yield? Usually NAV risk. You can take on that risk, take on duration risk, credit quality, interest rate sensitivity. We're the perfect rising rate solution because we have stops to go to cash on mutual funds. Very unique. We have all share classes to accommodate whatever the DOL does end up doing. A shares, we have fully liquid C shares. If anyone, I'm getting a lot of C share business from LaSalle. We pay the 1% on a monthly basis, so 1/12 of 1% each month. At the end of 12 months, you get 1%. In exchange, there's no back-end charge, there's no hold period, no CDSC, no fee in, no fee out on a C share. Most of my traction is on the fee-based side as of late. We're on the NTF platform at Fidelity, the TF platform at Fidelity. I'm having a lot of advisors send me their models and say, please show me how we can incorporate this as a 10, 20, 30% slice to help manage risk, reduce volatility. Or I'm having advisors saying, I'm sick of the burden and responsibility of picking my high yield fund, my low duration, long duration, core bond, muni, high yield. If a client wants a 60-40 stocks to bond allocation, I'll give you the 40, manage the bond side. So we can talk about how we can incorporate us into your practices because we think it's a good time to do it. I only have 2 funds, so if I were to pick my best idea, I got a 50% chance of getting it right. I keep telling the story. I was at a conference a couple months ago, and the JP Morgan guy's booth was next to me. And he was pulling out a ton of boxes and all this paper, and I said, how many funds do you have? He said, 143. And I take out my 2 boxes with the fact sheets, and I put them on the table. I'm like, all right, let's give it a go. So we have two strategies with the same process. They do one thing really well. Strategic Income Fund, I think, is our best idea because it fits really cleanly in a bond allocation. If you're looking for help in fixed income, cash off the sidelines, ways in a low interest rate environment not to take on too much risk, this is the process that you're going to want to consider. We just hit 5 stars. No one ever puts all their money in the Morningstar star ranking. Nice to hit 5 stars, though. I think it is a nice validation of our process and our risk-adjusted performance compared to the benchmark. We've outpaced the Barclays Agg by a good margin with a lot less risk and the ability to go to cash if rates rise or something unusual happens. I won't beat a dead horse, but statistics matter. Pretty unusual for a fund to have this consistency and this stability.